Welcome to this exploration of global economic tides and their impact on investment. Fasten your seatbelts as we journey through the dynamic landscape of finance. Imagine a ship navigating the vast ocean. The global economy is our ocean, vast and ever-changing. Economic trends are the winds and waves, sometimes predictable, often tumultuous. But within this chaos lies opportunity, waiting to be seized by those who understand. Let our journey begin. The past decade has been tumultuous for the global economy. Stock markets have ridden waves of exhilarating highs and stomach-churning lows. The US-China trade war created volatility and uncertainty. Tariffs and trade barriers threatened to disrupt global trade. The COVID-19 pandemic swept across the world, leaving economic disruption in its wake. The stock market is where rationality and emotion collide. When fear grips the market, even sound companies can see their stock prices plummet. Conversely, economic optimism can ignite a bull market. The dot-com bubble burst, reminding us that caution is essential. Market sentiment can turn swiftly and unexpectedly. Understanding market psychology is crucial. When a major player stumbles, the repercussions are felt far and wide. The 2008 financial crisis, triggered by the collapse of the US housing market, serves as a potent reminder. Banks faced staggering losses and credit markets froze. Stock markets plummeted as fear gripped investors worldwide. The crisis underscored the importance of diversification. Governments and central banks scrambled to contain the damage. Navigating the global economy requires prudence. Diversification is our compass in this ever-changing landscape. Stay informed and seek the counsel of financial advisors. Every crisis presents an opportunity. Market downturns can offer attractive entry points for savvy investors. Embrace knowledge, diversify portfolios, and maintain a long-term perspective. Real estate is more susceptible to global economics than one might think. When economies boom, demand surges and prices climb. Conversely, a slowdown in manufacturing and a rise in unemployment can chill the market. Within this ebb and flow lies opportunity. The astute investor can navigate these shifting tides. The dance between city and countryside is influenced by economic trends. Jobs in urban centers drive up demand for city dwellings. The rise of remote work allows individuals to seek a different pace of life. Property prices shift as demand changes. The astute investor keeps a watchful eye on these migratory patterns. Governments wield considerable influence over the real estate market. Interest rates set by central banks play a pivotal role. Lower interest rates make mortgages more affordable, boosting the market. Higher rates can cool down an overheating economy. Tax policies can also sway the market. The astute investor pays attention to these policy shifts. Investing in real estate requires patience and diligence. Diversification remains crucial in the property market. Explore residential, commercial, and industrial real estate. Thorough research is paramount. Real estate is a long game. Ride out short-term fluctuations. Trust in the enduring appeal of bricks and mortar. Commodities are the building blocks of our civilization. A booming global economy drives up demand for commodities. When the economic engine sputters, demand wanes and prices soften. The savvy investor can navigate the commodity markets with confidence, capitalize on the inherent volatility of these raw materials. Oil has long dictated the fortunes of nations. The rise of renewable energy is reshaping the energy landscape. Governments are enacting policies to incentivize cleaner alternatives. Oil remains a formidable player on the global stage. Demand is still substantial, particularly in developing nations. Opportunities exist for those who can navigate this energy transition. Gold has captivated the human imagination for millennia. In times of uncertainty, investors flock to gold as a safe haven. Its value is linked to its scarcity and enduring appeal. Gold's price can be volatile, driven by speculation and demand. the astute investor recognizes its role as a hedge in a diversified portfolio. Section 4. Riding the commodity roller coaster. Strategies for the savvy investor. Investing in commodities, dear viewer, is not for the faint of heart. It is a realm of volatility, where prices can swing dramatically in response to geopolitical events, weather patterns, and even the whispers of speculation. But for those with a strong stomach and a keen understanding of the forces at play, the commodity markets can offer the potential for significant rewards. Diversification, that trusty compass, remains as crucial in the commodity markets as it is in any other asset class. Don't put all your eggs in one basket, so to speak. Spread your investments across a range of commodities, from energy and metals to agriculture and livestock. Timing, dear viewer, is everything. Keep a watchful eye on global economic indicators, monitor supply and demand dynamics, and stay abreast of geopolitical developments that could impact commodity prices. Knowledge, as they say, is power. Consider too the power of hedging. Futures contracts, for example, can be used to lock in prices and mitigate the risk of adverse price movements. Options, while more complex, offer the potential for leveraged returns. The commodity markets, dear viewer, are not for the passive investor, but for those willing to embrace the volatility, to study the trends, and to act decisively. The Earth's bounty can yield impressive returns. Section 1. The steady hand bonds amidst the economic storm. Bonds, dear viewer, are often seen as the reliable workhorses of the investment world. While stocks may dance and commodities soar, bonds offer a certain predictability, a steady hand in the swirling storm of global economics. But like a sturdy ship navigating treacherous waters, even bonds must adjust their course in response to the winds of change. Imagine, if you will, a world of economic uncertainty. Stock markets fluctuate wildly, commodity prices gyrate with each news cycle, and investors, their nerves frayed, seek a safe harbor for their capital. It is in these moments that bonds, those beacons of stability, shine their brightest. Governments and corporations in need of funding issue bonds, essentially borrowing money from investors like you and me. In return, they promise to repay the principal amount at a future date, along with periodic interest payments. These interest payments, known as coupon payments, provide a steady stream of income, a comforting counterpoint to the often turbulent world of equity investments. But bonds, dear viewer, are not without their own complexities. Their value can fluctuate based on interest rates, inflation expectations, and the perceived creditworthiness of the issuer. Understanding these factors is crucial for any investor seeking to navigate the bond market successfully. Interest rates, dear viewer, are the conductor's baton in the grand symphony of the bond market. When interest rates rise, the value of existing bonds tends to fall. Conversely, when interest rates fall, existing bonds become more valuable. This inverse relationship, while seemingly counterintuitive, is a fundamental principle that every bond investor must grasp. Imagine, if you will, that you purchase a bond with a coupon rate of 5%. Now imagine that interest rates in the broader economy rise to 6%. Suddenly, your bond offering a lower interest rate becomes less attractive to investors. Its price will likely decline until its yield, which factors in both the coupon payments and the potential capital gain or loss, becomes more aligned with the prevailing market rates. Conversely, if interest rates were to fall to 4%, your 5% bond would become highly desirable, its price likely rising as investors clamor for its relatively higher yield. This interplay between interest rates and bond prices creates both opportunities and risks for investors, depending on their investment horizon and risk tolerance. Central banks, those guardians of monetary policy, exert considerable influence over interest rates. By raising or lowering key interest rates, central banks attempt to steer the economy towards stable growth and controlled inflation. Bond investors, ever vigilant, monitor these policy decisions closely, anticipating their impact on the fixed income landscape. Technology, that relentless force reshaping our world, is leaving its mark on the once-staid realm of fixed income investing. Fintech, that dynamic fusion of finance and technology, is bringing innovation and efficiency to the bond market, empowering investors with new tools and strategies. Online platforms, dear viewer, are democratizing access to bond markets. No longer the exclusive domain of institutional investors and high net worth individuals, Bonds are increasingly accessible to retail investors through user-friendly platforms that offer fractional ownership and low investment minimums. Robo-advisors, powered by sophisticated algorithms, are providing automated bond portfolio management, tailoring investment strategies to individual risk profiles and financial goals. These digital advisors can rebalance portfolios, manage maturities, and reinvest coupon payments with minimal human intervention, offering a cost-effective alternative to traditional financial advisors. Blockchain technology, too, is poised to revolutionize the bond market. Imagine, if you will, a world where bond issuance, trading, and settlement occur seamlessly and securely on a decentralized ledger, reducing costs, increasing transparency, and mitigating the risk of fraud. While still in its early stages, blockchain has the potential to transform the very infrastructure of fixed-income investing. Navigating the bond market, dear viewer, requires a discerning eye, a willingness to embrace change, and a solid understanding of one's own investment goals and risk tolerance. Diversification, that trusty compass, remains as crucial in the fixed-income realm as it is in any other asset class. Don't limit yourself to a single type of bond. Explore the spectrum of fixed-income securities, from government bonds and corporate bonds to municipal bonds and agency bonds. Each type of bond carries its own risk and return characteristics, and by diversifying your holdings, you can create a portfolio that aligns with your overall investment strategy. Consider, too, the importance of laddering your bond maturities. By investing in bonds with staggered maturity dates, you can reduce the impact of interest rate fluctuations and create a more predictable stream of income. As bonds mature, you can reinvest the proceeds in new bonds with potentially higher yields, further enhancing your returns. And finally, dear viewer, remember that bond investing is not a passive pursuit. Stay informed about economic trends, monitor interest rate movements, and pay close attention to the creditworthiness of bond issuers. By staying engaged and adapting your strategy as needed, you can navigate the ever-changing fixed-income landscape and achieve your financial goals. As we conclude our exploration of global economic trends and their impact on investment, dear viewer, let us remember the wise words of the ancient Greek philosopher Heraclitus: change is the only constant. The world of finance, like a vast and ever-shifting ocean, is in perpetual motion. We have journeyed through the dynamic landscapes of stock markets, real estate, commodities, and bonds, witnessing firsthand how each asset class responds to the ebb and flow of economic tides. We have seen how geopolitical events, technological advancements, and even shifts in consumer sentiment can send ripples across the global marketplace, creating both opportunities and challenges for investors. The key takeaway, dear viewer, is this: knowledge is power. By understanding the forces that drive economic trends, by staying informed about market dynamics, and by embracing a long-term perspective, we can navigate the complexities of the investment world with greater confidence and clarity. Diversification, that trusty compass, remains our constant companion. By spreading our investments across different asset classes, we mitigate risk and enhance our chances of weathering the inevitable storms that arise. And by seeking the counsel of experienced financial advisors, we gain valuable insights and guidance, ensuring that our investment decisions are aligned with our individual goals and risk tolerance. The journey of an investor is a lifelong pursuit, one that requires constant learning, adaptation, and a healthy dose of prudence. But armed with the knowledge and tools we have discussed, dear viewer, you are well equipped to chart a course through the ever-changing seas of global finance and reach your financial destination. Remember, the future belongs to those who are prepared for it.